Good morning and good afternoon, everyone. It is October 9, Thursday. Welcome to Morgan Stanley Asia Macro Webcast. My name is Crystal G, Asian EM Market Strategist. Before we start, please note that this event is for Morgan Stanley institutional clients and financial advisors only. It is not for a member of the press. If you are a member of the press, please log off and reach out separately. Please also note that this webcast and your questions may be recorded. Today we have Robert Feldman, Senior Advisor, Masayuki Inui, Japan economist, Koichi Sukisaki, Head of Japan Macro Strategy, Daniel Blake, Asia EM Market Strategist and Head of APS Quant Research, Upasana Chatra, Chief India Economist. During this session, you can send us questions at any time from the Ask a Question text box. Following the LDP election result over the weekend, the fiscal and monetary policies might be a little bit more moderate than expected. Today, we have Robert Feldman and Inui-san to share policy outlook. Let me invite them both to share their takeaways.
Okay, thanks very much, Crystal, and thanks everyone for joining us on the call today. I think the key message is the one that Crystal just mentioned, which is after Takaichi was elected LDP president, her statements, her press conference showed a distinct move toward the center, move toward moderation in the kind of policies that she talked about at the press conference relative to the things she had been saying before. I will leave her statements on monetary and fiscal policy to Inui-san, but I want to stress her approach to growth strategy in Japan. Takaichi has been known for a long time as somebody who really wants to push better technology, use it to improve productivity, raise wages, and the format in which she is proposing to push that technology diffusion is through policies on national economic security, particularly energy and agriculture and infrastructure resilience. Now, how far she's willing to go on that, that's not so clear. Exactly what she has in mind is not so clear, but that is the growth strategy they are taking now. What's missing from that growth strategy is any sense of microeconomic reform, because she didn't mention much about that. And this is going to be very interesting because from the work I've done, you cannot get that technology diffusion to be as fast as it needs to be unless you also have microeconomic reform at the same time. So we'll see how her policies evolve on that. So that's the first page. If I can ask you to go to page 3 in the handout, then that will show the difficulties going forward. The question now is not so much what her policies are. The question is, what can she actually get done in the current diet? And she has two issues. One is the unity of her own party, the LDP, and her own coalition. The appointments she has made to her inner circle all come from the same ASO faction or very closely related factions who are more on the right wing of the party. So it doesn't look very much like a unity approach, although I'm sure she'll try very hard on that. But we've got to be very careful to see if the LDP actually coalesces into a single unit. The second issue she has, as you can see on this slide number 3, is how do you put the diet votes together to get any legislation passed? As long as the Komeito stays in the coalition, it's not that hard. As you can see in the upper elements of these two tables, with the Komeito still in the coalition that is voting with the LDP, you would only need one of the other centrist parties, the Democratic People's Party or the Osaka Ishin Party, to get a full majority. It would work fine. If the Komeito decides to leave the coalition, and there has been a lot of news reporting about how that is quite possible, then there could be issues. So we'll have to watch very closely about how she manages to put a coalition together. In addition, there have been some meetings of the opposition parties along with the Komeito about maybe considering some other way of forming a government. So this is very, very fluid at the moment. And we have to watch whether the LDP can pull things together or whether Takaichi can pull things together to have a working coalition. So things are not very clear in terms of how the politics of things of the current situation can actually get things done, regardless of what her policies are. That's kind of unknowable. That said, the policies themselves are very interesting. And so let me pass things to Inui-san to talk about monetary and fiscal policy, and then on to Sugisaki-san and Daniel Blake for the bond and equity parts of the story. Inui-san?
Yes. So thank you very much. This is Masai Inui, the economist from Japan Account team. So I agree. Like this is very very like interesting. The opportunities. Like that, the Takaichi defeated the Shinjiro Koizumi in a round of both to become party president. I think the outcome itself was the kind of like a surprise to many market participants. Like the last week, I visited the Hong Kong and Singapore for the meeting the clients, and then I had the impression that many expert views that the Koizumi seems to be the more like a front runner. So in this sense, it would be like a surprise. So that would be very important to discuss this topic. The Takaichi was initially expected to be nominated as the next prime minister in the extraordinary diet session, like on the October 15th. But that said, it seemed like the timing of nomination would be delayed. And then the news headline right now is discussing delaying to in the week of the October 20th. So we also have like an impression that Takaichi right now is seeking for the coalition partner, like the Robbie mentioned, like DPP, and also like in addition to traditional coalition partner Komeii. But in the leadership race, we also have impression that Takaichi appeared to shift toward more moderate conservative stance to broaden her support within the party. And then she refrained from reiterating past remarks on cutting the consumption tax cut or like the upholding the Bank of Japan rate hikes and also other like diplomatic things. So we think this shift may have contributed to her gaining additional votes from the LDP Diet members in the runoff. But we believe concerns among some investors that the next administration might pursue extreme fiscal expansion or put political pressure on the BOJ would be overblown. Her policy platform includes also the measures such as the refundable tax credit, abolish the provisional gasoline tax, and the investment promotion tax incentive and efficient aging infrastructure upgrades. So as for the monetary policy side, we think Takaichi's stance is aligned with BOJ Governor Ueda's cautious stance. Let me quote her comment. She mentioned in her press conference after the LDP leadership election, she said, I believe Japan's economy is on the edge. It's premature to feel reassured just because we are no longer in deflation. The idea is demand pulling inflation where wage growth drives demand, prices rise moderately, and then the companies benefit. The Governor Ueda also has noted the resilience of the Japanese economy, but on 2 points. First, cautious views on the impact of the U.S. tariffs, and the second, the belief that food inflation, the main driver of Japan's inflation, is largely supply-driven. The Takaichi stance appears closely aligned. In a post-election press conference, Takaichi stated that the government and Bank of Japan must work in close coordination. The responsibility for fiscal and monetary policy lies with the government. I view the Bank of Japan as the institution that determines the best means for monetary policy. So some like news headlines discuss this issue as Takaichi's strong stance for the putting pressure on the BOJ's independence. But this reflects a nuanced understanding of the distinction between goal independence and operational independence. And this is aligned with Article 3 and Article 4 of the Bank of Japan's Act. So though we had observed the growing expectations among investors for a rate hike in October, particularly after September 29 board member Noguchi's speech and then before Takaichi's victory. But market expectations for a near-term rate hike has receded this week. We haven't changed our view that October rate hike is premature, but at the same time, we also think that it should be careful to examine her stance on monetary policy. So let me quote her comment again. She said that the current inflation, like the supply side inflation, is not so good, but she also thinks that wage growth driven inflation would be the ideal. So in that sense, Takaichi has distinguished supply-side-driven inflation, wage growth-driven inflation. So going forward, I have the impression that the Monetary Affairs Department of the BOJ would need to adjust their logic for rate hike. Before Takaichi's victory, they had discussed the potential propagation of headline inflation to underlying inflation, which is rather supply-side focused. So given Takaichi's stance on making mature wage growth-driven inflation, they would seek for connecting wage growth and underlying inflation trend more clearly going forward. It would be critically important to see such kind of changes in the policy discussion from BOJ side via MPM press conference, board member speeches, etc. But in any case, if concerns over US tariffs ease and Japan's recovery becomes more evident, with inflation reaching 2% driven by wage growth, in that case, we believe that even Takaichi administration would not oppose BOJ rate hike. So let me stop here and then let me hand it back to you, Crystal.
Thank you so much, Robbie-san and Inui-san. In terms of market implications, we have Sugisaki-san on the line as well to discuss the impact on yen also rates. Would you see upside surprise to the current dollar-yen forecast that you see 126 till the end of next year?
Yes, sure. Thanks for inviting. The election outcome was totally, to be honest, a surprise for the fixed income investors because the market basically saw the only like 10% to 20% chance of the Takaichi-san's winning. So the initial reaction in the fixed income market is like weaker yen and twist steepening of the JGB curve. Because the market broadly see the Takaichi-san favor the expansionary fiscal policy and the accommodative monetary policy as well. That said, the rate market seems to find the support after confirming the reasonable demand on the 30 JGB auction this Tuesday. Market, of course, worry about the potential expansionary fiscal policy under the administration, particularly if the DPP will join the current coalition. But they also recognize that the increase in the long-run JGB issuance would be highly unlikely, irrespective of the size of the fiscal stimulus, given the structural supply-demand imbalance on this sector, and MOF already fully understand this point. On top of that, according to the recent media articles, Takaichi-san's primary economic agenda, including the several key components. The first is the implementing the income tax cut and the direct cash payout to help alleviate living costs. Number two, the abolishing the provisional gasoline and diesel fuel tax rate. Number three, the providing the support for the hospitals and the nursing care facilities facing the financial difficulties. And finally, like expanding the subsidy to the local government to assist the small company and small business. Like the framework for the incoming tax cut and cash payout may take a few years to establish, and the immediate financial requirement for the other initiatives seems to be very low, such as for example, like a couple of trillions. So we think it could be easily financed by the usage of the tax revenue windfall and no need to issue the additional JGBs in the market. So the perception for the Takaichi-san's perception is really like stimulative, and but the reality may be far less than the expected, to be honest. And on the other hand, the market gradually retraced the initial short covering in the front end of the curve as the dry yen continued to grind higher above the 150. And the Takaichi-san also suggested the direction of the both fiscal and monetary policy should be directed by the government, although the actual monetary policy decision should depend on the BOJ. She also mentioned the BOJ should maintain the accommodative monetary policy to drive the demand-driven inflation on the back of the uncertainty among the U.S. tariff impact. which seems to be, as Inui-san mentioned, similar as the current weather sun's cautious approach. So in theory, front-end rates should go lower. But cynically, the drastic yen weakness post the LDP leadership election appeared to generate the renewed speculation for the hawkish BOJ rate hiking cycle because the BOJ may have to tackle with the weaker yen. So the flattering trend may continue as far as the dollar yen continue to grind higher. But we are a bit cautious to position for the hawkish BOJ rate hike this time, since the market already pricing the very optimistic BOJ hike path, with one hike per 6 months to the terminal rate to the 1.25% by the end of the fiscal year 2025. We also think the current yen weakness has been mainly driven by the speculative yen short positioning led by the leverage funds. FX markets seem to speculate that the BOJ would become difficult to hike anytime soon due to the political pressure, and they assume that the U.S. economy remain resilient, supported by the strong AI investment in the absence of the official U.S. economic data. This coupled with the lower expected volatilities might boost the yen carry trade demand in absence of the U.S. economic data under the government shutdown. However, this low volatility regime could end once the U.S. economic data starts to be released again after the government shutdown end, or the prolonged maybe the government shutdown which prolong, which means that the risk sentiment might start to worsen. The Takaichi administration will likely deliver the economic package size eventually, but subsequently government finance needs maybe not the market expected. So this type of the three catalysts could change the current trend of the dollar yen, and we think the current dollar yen level is really high compared to the fair level implied by the U.S. terminal rate pricing. We think the current fair value of the dollar yen is 142, but the dollar yen is currently trading the 152. So almost like a 10 yen's divergence between the fair value and the actual level. And this basically driven by the speculation for the foreign investors. In absence of the U.S. economic data, such speculative yen positioning might be accumulate further in the near term. I agree with this point, but we don't want to chase a level highest, given the risk of the another volatility coming into the market once the government shutdown particularly may open. So I think basically we continue to maintain the cautious stance for the dollar yen, and we see the risk of the dollar yen to go lower below the 145 if the such kind of event will happen in the near term future. I'll stop there and back to the question.
Thank you so much, Sugisaki-san. That's a very insightful comment. Now we are shifting to agri strategy, and today we have Daniel here to talk about how do you expect investors to react in the coming month, and also what's your view on the impact on valuation earnings for Japan. And also another topic is the team launched the first thematic monthly. So can you share that report as well?
Okay, thanks, Crystal. So it's timely, actually. We've got Sho Nakazawa, our head of Japan equity strategy in Singapore. We held a symposium just this morning, and on behalf of the entire team, before I get started, I wanted to reach out and request your support for the Japan Extel survey. We know that the Asia ex Japan is very closely watched, but Japan is equally important for us as a firm. So across the team presenting here, as well as Sho Nakazawa ourselves, please do take some time out to extend support. That's much appreciated. So in terms of the view on Japan, I think what we're hearing is a relatively moderate set of views from the team, and we obviously have a lot of risks that we need to watch, particularly as we've got an upcoming meeting that's going to be held by President Trump with someone in Tokyo when he comes later in October. So let's see if that is Takaichi, if she is installed as Prime Minister of Japan in the Diet later this month. But in terms of the views, this more moderate stance does bring us back to where the fundamentals sit, and we have had an overweight stance on Japan, which has really been delivering sustained earnings outperformance of expectations, sustained earnings growth, and we think that is likely to continue. So we've been watching the corporate reform, we've been watching the domestic reflation, which is underway, and so while there's concern around this being cost push, it ultimately is leading to better corporate profit margins. And you can see here the trends that we've seen for Japan, where we've seen since Abenomics got started back in 2013, 10% compound growth in earnings per share being delivered in local currency terms, and 4 to 5% in US dollar terms. So this has been a really successful story compared with the lack of any growth being delivered by EM or in aggregate by the China market, if we're looking at the rolling expectation of 12-month EPS. So as we're looking at the backdrop here, we've seen earnings delivering a lot to the investment outcomes for Japan, but we've recently seen valuations really boosting that. And as we update now for spot prices post-election, we're up to 16 times for Japan. This mustard coloured line you can see here has only really been exceeded in recent memory for a brief period during 2020, 2021, which was the post-COVID investment boom that got picked up, and China was really leading a lot of that re-rating, but we did see all markets, particularly export-oriented markets, driving higher valuations, but not being sustained. So we are watching for risks to this re-rating that has come through, and I think we heard from the team some of the things that we should be watching, including the fact that dollar yen has been driven by CTA leverage fund positions. We do have uncertainty around the tariff and investment frameworks between Japan and the US. And ultimately, we've got a US growth slowdown, which is in the forecast for 2026, where we're looking for US growth to slow down to between 1 and 1.5%. So soft landing, sure, but still the tariff impacts not being fully digested. So that brings us back to the fundamentals post Takaichi, and I'll talk to some of the sector comments and macro comments from Nakazawa-san and for ourselves. So overall, we can see here that the market has been driven really by domestic demand-driven stocks, by corporate reform, but now we've got this additional tailwind coming in from a weaker than expected yen. Corporate guidance is assuming a dollar yen level of around 143. We think analyst expectations are similarly assuming that low 140s level. So the longer we have this upside, it's producing upside risk to the earnings forecasts. Overall, we also see the corporate reform still paying dividends, literally, and seeing significant increases in buybacks coming through. But we don't think that corporate reform journey is complete by any means, especially if we look at the right-hand side here, the extent of cash that's sitting on balance sheets still being a key focus for the potential upcoming revision of the corporate governance code. So bringing it back to Takaichi and what's in the price, as we look at the next phase of leadership, we think the sector trends are going to be important. And what we've seen is while there's maybe more moderate tone in terms of macro policies on three arrow type approaches, what we're seeing is still a very strong focus on economic security, on defence, reiterating commitments to double defence spending to 2% of GDP. Looking at infrastructure, looking at the semiconductor industries and bottlenecks and choke points that have emerged. and ultimately being supportive of this reinvestment program that is coming through in Japan. So we do think this is a constructive setup. And just to again conclude in terms of where we sit here, with topics trading just around 32.50, that's trading at our bull case for June 2026. It's really assuming, I think, that we do see sustained dollar yen levels around here that can then deliver this earnings growth that would come in above consensus. We did see in 2020 in the June quarter results, and that we did see earnings surprise on the upside, having been expectations being lowered around the tariff risks. So now if we see that further uplift to earnings expectations, you can see here that in our bull case we're looking for something like a 9% outcome, 11% next year. That is feasible, but it does require, I think, a pretty soft landing view of the tariff impacts, but also this sustained weakness in the yen, which can add 4 to 5 percentage points to the earnings outlook, particularly for exporters. On the sector trends, then looking for key value exporters that can benefit from that weaker yen, but also looking for financials to maybe not be as negatively impacted as some feared by Takaichi leadership, because ultimately what we're seeing here is an ongoing focus on reflation of the Japanese economy, and banks being some of the most highly exposed to a reflationary policy backdrop, even if it means uncertainty about just how quickly we move ahead with rate hikes. So overall, in conclusion, a constructive stance we've got on Japan equities, but given how quickly we've seen aggregate markets rallying, and we do have some exposure to that dollar yen level that's trading above fundamentals, there is some risks in the profile that we need to be watching, but we should be looking at continued beneficiaries coming through, including in this semiconductor localization, critical minerals, defense investments, reinvestment programs coming through, benefiting some of the construction names. And we remain overweight on Japan financials, both banks and non-bank financials, as beneficiaries of a broader reflationary stance for Japan. So I'm just going to switch topics there, and I'll be brief on this, which is showing our launch of a thematic strategy monthly report. In this report, we do include, before we get to the feature topic, we do include a dashboard of where we see growth expectations, where we see valuations and performance of key themes and sub-themes, including, as we're talking about Japan, the performance of Japan corporate reform, delivering, for example, 13% returns over the last 3 months. So we can see the performance, we can see the valuations, and bottom line earnings expectations here sitting at 9.7% CAGR growth for the corporate reform stocks that we see benefiting from unwind of cross-shareholdings, buyback momentum, potential MBOs. So within this, you can see the performance trends and also our scorecard of how we see these sub-themes ranking. And so do take a look through the positioning here. We include our thematic focus list and any changes that we make. So 25 stocks, making 2 changes, which include taking profits on Linus and BHP, switching into Aluka and GemLife, which is a Aluka for again rare earth processing, mineral sands, and GemLife for a retiree focused housing developer that's a longevity play. And then our feature topic is looking at this concept of what's worked from a factor perspective in trading thematic investments. And 2 things really jump out with conviction. That is that small caps have crushed large caps in the thematic universe. And so this is quite a natural conclusion of what some in Stanford have called the innovator's dilemma. And that's really relating to this idea that incumbent companies, almost by definition, need to focus on their existing product, their existing client base, may not be leading the disruption or the innovation that's happening. And that process has meant that small caps have tended through time to systematically outperform large caps between 13 and ultimately 25% across different themes per year. So do look for small cap opportunities. And second key theme is that we've seen the the outperformance of momentum, whether it's earnings momentum, sales momentum, or price momentum. They have systematically delivered outperformance. So we're showing the relative performance of long sentiment stocks versus short sentiment stocks in log terms, and that's really consistent across themes. So in other words, don't fight the trend. If companies are pulling forward their sales expectations or their earnings targets, if they're delivering strong price returns, it's dangerous to be fighting against that trend and taking profits too soon. And so that's the second key conclusion of the work we've done on quant overlapping with thematic investment trends. So do take a look through the monthly report. Any charts you want to see on thematic performance should be there, and we stand by for any questions as well. So with that, I'll pass to you, Crystal.
Thank you, Daniel. We have a last topic here on India. And then because of the India data remain mixed in September, and investors are quite well aware of the cyclical slowdown. But there are some silver linings around GST tax cuts. Upasana, can we have you here to talk about your expectations for the next few quarters? Over to you, Upasana.
Sure. Thanks, Crystal. And hello, good morning, everyone. So I'll just go over what we are seeing from high frequency growth data in the last month. And this is, of course, of a lot of interest given that data until now has been mixed, and there have been quite a significant change in the stance of policymakers, both fiscal and monetary, towards supporting domestic demand, especially consumption. We've seen monetary policy easing, and that has now been matched with fiscal easing through indirect tax cuts. The data for September remains mixed, mainly because of not just seasonal factors, but also with the impact of the tax cuts that were announced earlier in September and then have been effective around September 22nd. So I hope you can see the screen, and I'll just share a few charts, actually the heat map on what we are seeing from a high frequency basis. High frequency data for September, as I mentioned, remains mixed. What we are seeing is that GST collections, which is the key in terms of timeliness on broad-based economic growth momentum, has recovered in September. So despite the tax cuts being announced and some amount of deferment of purchases, what we are seeing is that GST tax collection growth on a YOY basis is now at about 9.1% versus the trough of 6.2 in June 25. Similarly, on a real basis, also the numbers are recovering. We are seeing recovery in credit growth, though still pretty modest, but from the near-term trough of around 9.5%, numbers are above 10%, and again adjusted for inflation, because inflation is running pretty low right now in India. Again, the numbers are looking better versus where we were 3 to 4 months back. On the consumer or labor market side as well, there is some positive news with the organized sector job growth, which is running at about 10.1%. Again, the year-to-date trend is better than what we, or rather positive at about mid-single-digit levels versus a decline in the last year. What we are not seeing, a major change right now is in some of the indicators related to like air passenger traffic, which remains a bit weaker versus where we were earlier in the year. So there has been some modest moderation in this segment. Similarly, in power demand, real freight, etc., we are not seeing any major change. At the same time, rural demand remains pretty strong, and rural demand related indicators like a few at the bottom end of the heat map, if you were to see, like tractor sales growing double digit, and in early reads for September, while we don't have the full data here, also remain pretty strong, and that bodes well, because what we've seen from a monsoon perspective is also that we are seeing still pretty decent trend in the crop sowing data for the summer crop season, which just ended, and the rainfall season was also decent, which means that there has been a decent pickup up in the reservoir levels, which bodes well for the upcoming winter cropping season as well. So I think rural demand continues to remain supported, driven by these tailwinds of better agriculture output, lower inflation, which improves real purchasing power, and continued support from the incoming agriculture season in the winter season as well. Early reads, what we are seeing now from the festive season and the impact of GST cuts can be tracked through the trend in auto sales and what we are seeing from daily data and credit card spends. Over here, if we look at this table, we are seeing pretty much like a 20% growth on a like-to-like basis for the festive season. The festive season in India keeps changing, and that's why the full month data for September remains impacted if we were to look at auto sales numbers as well, both wholesale and retail. But just looking at the 2-week period of the festive season, which just concluded, we see that there is a 20% sort of growth across passenger vehicle and two-wheeler sales as well. Similarly, credit card spends on a daily basis are up 24%. This number was pretty weak in the last few months, almost at low single-digit levels in terms of growth. So now just to conclude, I think they have a number of triggers to support domestic demand, and especially on the consumption side. So monetary policy easing, firstly, we have seen rate cuts of 100 basis points by the RBI, which have been front-loaded. Liquidity remains in surplus. And at the same time, the RBI has been also conducting regulatory easing, which is positive from a bank's loan growth and profitability perspective. So we do think that the second half consumption demand will be supported by monetary policy easing. Second is the fiscal impact, which is the GST cuts alongside the direct tax cuts, which were initiated at the beginning of the financial year itself. So both fiscal direct and indirect tax cuts will add roughly about 0.7 to 0.8% of GDP on an annualized basis, with multiplier impact on the indirect tax cuts being higher, and therefore they can have more impetus on consumption. And lastly, from a real purchasing power perspective as well, lower inflation is helping improve purchasing power with improvement in real wages, both rural and urban at the margin. And as I mentioned, there is some improvement in the labor market conditions as well, especially from a weak starting point of last year. So inherent labor market conditions improving will also bode well for consumption demand. So in all, we think for second half of this year, we do expect demand to remain supported by domestic demand mainly. So the composition of growth could change with consumption being the mainstay and CAPEX remaining supported, though a lot of CAPEX activity has been front-loaded in this year by the government. And external demand, of course, remains a source of uncertainty and concern, especially given the higher tariffs that India is exposed to. And at the same time, the uncertainty around the impending trade deal with the US. And therefore, the second half, as I mentioned, would probably see weakness from external demand while domestic demand remains supported. Just to conclude, our numbers for fiscal 26 in terms of growth are at 6.7% and at 6.5% for next year. So we continue to see India delivering pretty healthy growth rates in the next few quarters. I'll stop here for any questions, and I'll rather pass it back to you, Crystal.
Thank you, Pasana. So now we are moving on to the Q&A session. We have a lot of questions on Japan online. The first two are for Masa. The first question is, if Takaichi-san is elected to be Prime Minister, how do you view the impact on US-Japan relationship? And the second question I'll just ask altogether, how to expect the measures, including the fiscal 25 supplementary budget under Takaichi? Do you think it will be a larger package compared to what we have seen the last 2 years?
Yeah, thank you very much. These are very, very important questions. I think there will be that Donald Trump, like U.S. President Trump, will come to Japan, and then we see a meeting will be scheduled for the Takaichi and Trump summit, maybe like around 28 or something, and that would be like the expected key diplomatic event. But in a press conference of the post-LDP elections, the Takaichi also emphasized the importance of confirming the strengthening of the U.S.-Japan alliance. And also, like she clearly denied the possibility of renegotiating the U.S.-Japan trade agreement, which including like large scale investment, which was initially finalized under the Ishiba administrations. And then we understand that some investors had a concern about the renegotiation, but she has already denied. So in this sense, we do not see like the a bad, like a negative impacts from the Takaichi becoming the new prime minister, given considering the relation between Japan and the U.S. And as for the fiscal expansion tool, like the supplementary budget, that is also like the very important topics going forward. But in any case, at this point, as you know, like things are quite fluid. So we would pay attention to further communication from the Takaichi side, and then whether she could make it the nominations. The I mean, like as I mentioned before in our discussion, the timing of the nomination of the prime minister has already been delayed until in the week of October 20th, and then going forward, we would get much more information about it. So we need to pay close attention. But that said, we also believe that measures to address rising prices will be a central focus in the upcoming supplementary budget discussions. That said, like a big policy scheme like the refund of tax credit, it could take time. But in that case, in the upcoming supplementary budget discussions, the fiscal measures may be debated, including like the expanding grants to local governments, increasing medical and nursing care fees, and abolition provisional gasoline tax rate, etc. But in any case, I think going forward, one interesting data point would be the July to September GDP numbers. So we expect the July to September GDP number may fall in negative growth temporarily, mainly driven by the special factor coming from the reactionary decrease in the housing start. That kind of like a GDP fluctuation would not be so important for the BOJ's policymaking process. That said, typically speaking, politicians may have a strong interest in whether GDP growth turning to negative or not. So in this sense, the one checkpoint going forward is how the supplementary budget discussions would getting more like active after the negative GDP growth for July to September released. But in any case, it's kind of like getting like a fluid at this point. It's better to pay attention to it.
That's super clear. Thank you, Masa. And the next question is on dollar yen. So Sugisaki-san, how do you balance your views of the impacts on dollar yen from the Fed and US hard data versus the actions of BOJ?
Yes, sure. I think the Fed's like a rate hike past pricing and the incoming the US hard data should be a much more important versus the Japan specific issues. People basically like position for the long dollar yen for the carry purpose, and this basically require the prospect for the policy diverge. How the policy path between the US and Japan will be developed in the near-term future. So in such a case, the people already like pricing the, for example, like the 1.25% of the terminal rate on the BOJ, and thanks to the Takaichi-san's victory, they may price out the BOJ rate expectation, terminal rate expectation from 1.25% maybe to like something like the 1% or even like 0.5%, but only like 75 basis points range of the change. But if you look at the Fed, we have the various, we can assume the various outcomes. There are some like, if you look at the SEP dot plot, there are some like folkish Fed members basically see the terminal rate should be around 3.75%. But the most like dovish guys, except like Steve Millen, is maybe like 2 to 2.5%. So the range of the outcome term should be like a 2% to the 3.75%. So I think the Fed rate hike path and should be the much more important driver for the from the carry perspective. And the U.S. economic data is much more affect to the future Fed policy path. So this is why we basically focus more on the U.S. side of the factor. And on top of that, if you look at the BOJ's policy, it's really interesting that even if the Takai-san will be was actually nominated the next LDP leaders. But if you look at the BOJ pricing in the following 12 months, this will not much change because this type of like a reaction, like initially like the market price in the dovish BOJ rate hike pass, but once the dollar yen got higher, market reprice the BOJ hike pass higher. So they are almost like the BOJ. So the BOJ's market pricing have not changed much between the LDP leadership election. So, but like yen was actually have weakened by like 5 to 6 yen. So where these like weakness basically came from? I think the strong investor perception that the Takai-san really push for the dovish BOJ and the push for the fiscal stimulus, although they don't understand the how much the actual fiscal stimulus could be delivered. So this type of like a perception was really triggered the recent weakness. So if the people actually get the actual numbers, I think such kind of like optimism will likely be faded in the future.
Thank you, Sukisaki-san. We'll take the last question here, and this one is for Upasana. How do you view the tariffs impact on growth, and then do the current set of India high frequency numbers contain the negative spillovers already?
Thanks, Crystal. So the tariff impact on growth at the direct level, the goods exports, which is impacted by the higher tariffs, is about 1 to 1.2% of GDP. This is not a very meaningful number, and therefore the direct impact in context of the recent depreciation in the currency is also looks to be more manageable. So if you see in the currency performance, USD INR has been one of the laggards and was performing in terms of YTD nominal depreciation. And on a real effective exchange rate basis, the currency has depreciated by about 6.5%, putting it under the undervalued zone as well. So in context of the tariffs, of course, at a 50%, it is a big disadvantage. But if you contextualize it versus where it is in terms of the share of GDP, the sectors getting impacted, and then in context of the currency offset, it does look to be more manageable. But of course, the longer it extends, the higher the downside risks, especially from the associated channels of impact on capex and employment. The sectors impacted on a direct basis are also more labor intensive, like exports of gems and jewelry, textiles, leather, and certain agriculture, aquaculture products like shrimps, etc., where the labor intensity is higher, and therefore there is going to be concern on joblessness as well. As of now, as you asked, is there an impact on the spillover impact? Not really that we are seeing any spillover impact because of the lower external demand. Also because there has been front-loaded shipments to the US. So if you look at data of exports to US, that's been growing almost 20% April to August. Versus sort of flattish growth on headline export numbers. So we are not going to be, it's not as there yet in the numbers, but yes, we have to be now watchful, especially for incoming data as we get for September in terms of what is the impact. There has been some partial, very small impact in terms of exports to the US in August as the tariffs kicked in. But I think from September onwards, we'll see a more, the data will be more telling in terms of how the impact unfolds. So we remain watchful of this trend. And in terms of impact, we are building in lower external demand through the direct and the indirect channel, especially through lower global growth as well for the second half of this year.
Thank you, Upasana. In the interest of time, we'll conclude today's podcast here and answer the remaining question offline. Thank you so much for joining us, and do reach out to me and the team if you have any other questions. Have a nice day ahead and see you next week.